The start of each calendar year marks an opportunity to contribute additional funds to your tax-free savings account, or TFSA. So we wanted to take this opportunity to provide an overview of these accounts. We often see people either not taking advantage of their TFSA or confusion surrounding when or how to most effectively use them. So we wanted to take this opportunity to clarify some of these questions for you today. We will start with a general overview of what is a tax-free savings account and how does it work. Who is eligible to open a TFSA, and what are the key benefits in having a TFSA? How much can you contribute and how much can you withdraw? And then we're going to speak a bit about how does a TFSA differ from an RRSP, and what are some of the key mistakes to avoid to ensure you're using your TFSA most effectively going forward. So to get started, what is a tax-free savings account and how does it work? The TFSA was introduced in 2009 by the Canadian government as an additional incentive for eligible Canadians to set aside money and grow tax-free throughout their lifetime. Contributions to a TFSA are not deductible for income tax purposes, as they are for RRSPs. However, any amount contributed, as well as any income or gains earned within the account, are tax-free, even when the funds are withdrawn. While the name refers to a savings account, you can hold a vast array of qualified investments within your TFSA, which is similar to an RRSP from that aspect, including cash, GICs, publicly traded listed stocks, bonds, ETFs, or mutual funds. So let's discuss who is eligible for a TFSA, because this can cause some confusion specifically for non-resident or people considered to be US persons. So tax-free savings accounts are available to every Canadian resident who is 18 years of age or older with a valid social insurance number. It's important to note that if you do become a non-resident of Canada for tax purposes at any time after opening a TFSA, you can keep your TFSA and will not be taxed in Canada on any earnings within the account. However, if you make a contribution while you are a non-resident, you will be subject to a 1% tax for each month the contribution remains in the account. It is also important to note that TFSA contribution room will not accumulate for any year during which you are a non-resident of Canada throughout that entire year. So if you are not a resident in Canada the entire year, you will not have contribution room for that year. If you're a Canadian resident but considered a US person, perhaps a dual citizen living in Canada, it's important to seek tax advice. TFSAs are not recognized as tax-free accounts for US tax purposes, and therefore income realized each year must be reported on your income tax for the US. So it is therefore typically advised not to open a TFSA account for US persons, but again, we really recommend seeking tax advice for your personal circumstances in that situation. Now, when you look to name a beneficiary on your TFSA, you really want to be aware that there's two types of beneficiary designations for TFSA purposes that you want to be aware of. So first of all is a survivor. Now, this can be a spouse or a common law partner of the TFSA holder, and that can be designated as a successor holder. Now, in this situation, the TFSA continues to exist and the successor holder assumes ownership of the TFSA. The successor holder's unused TFSA contribution room is unaffected by assuming ownership of the deceased holder's TFSA. If a successor holder has their own TFSA, they can directly transfer the value from one to the other to consolidate those accounts. Now, the second option is a designated beneficiary, and in this case, that might be a former spouse or children, for example. In this case, beneficiaries can contribute any amount that they receive to their own TFSA only if they have TFSA contribution room available. So this is a really key difference to be aware of when you're electing your beneficiaries on your TFSA. A successor holder can assume ownership of the TFSA and their contribution room is unaffected. A designated beneficiary can only contribute amounts received to their TFSA if they have unused contribution room available to do so. And the balance would then be put into a non-registered account and would no longer be tax protected going forward. So something to be very keenly aware of when you're electing that beneficiary. Now, why are TFSAs so useful? Let's talk about some of the key benefits that TFSAs offer. So first of all, and the most obvious, is tax-free growth. This is an additional vehicle for you to take advantage of for investments to grow tax-free for your lifetime. We don't get many tax breaks in Canada, so please make use of the ones that we do have access to. Secondly is enhancing your retirement planning. A TFSA is a great tool to complement your RRSP and other potential retirement and income, such as CPP or other pensions. It offers an additional tax advantage account that you can continue to build when you have no more contribution room available for your RRSP, for example, as well as past the age of 71, when you're then required to convert your RRSP to a RIF and start making withdrawals. There is no age maximum on your ability to continue to contribute and build your TFSA, which is a great benefit to take advantage of. And third, flexibility. A TFSA can be used to work towards both short-term and long-term goals, given that you have the ability to withdraw the funds at any time without paying tax. So how much can you contribute to your TFSA? Once you have opened a TFSA, you can contribute your contribution room that's going to consist of 3 components. 1 is your current year's contribution limit. 2 is any contribution room that's unused from previous years that's accumulated. And 3 is going to be the value of TFSA withdrawals made in the previous year. So the TFSA limit for each year is set by the Canadian government and indexed to inflation. For 2023, the limit has been set at $6,500. Now, this contribution limit applies to all Canadians over 18 equally and is not related to your personal earnings. Your contribution limits are cumulative, meaning that if you don't deposit the maximum in one year, you can make up for it in future years. So if you were 18 years or older in 2009 when TFSAs were launched and you have not yet contributed to a TFSA, you have 88,000 of total accumulated contribution room available as of January 2023. Now, how do you find your contribution room? The CRA tracks everyone's contribution room through your social insurance number. You can obtain this information through registering at My Account on the CRA website or downloading the My CRA app. It will now show your contribution room available as of January 1st, 2023, but it's really important that you monitor your contributions and withdrawals, as this website can be delayed in being updated, so you want to make sure that you're very careful in terms of not over-contributing. Now let's address how and when you can withdraw from your TFSA. So one of the key benefits of a TFSA is the ease of withdrawing funds, and this is what makes it a really great vehicle for planning for both short-term and long-term financial goals. So generally, you can remove money from your TFSA at any time for any event and with no penalty. Withdrawals made from your TFSA in the year will only be added back to your TFSA contribution room at the beginning of the following year. So you will want to track the total amount of funds that you take out of your TFSA so that you know the total amount of contribution room that you're going to have available to you in the following calendar year. It is really important to remember that you cannot recontribute those funds that were withdrawn in the same calendar year. Doing so would be considered an overcontribution and subject to a 1% per month penalty, so it's very, very important that you track those withdrawals and when you can recontribute. One tip to be aware of, for those that are withdrawing funds that are intended to be replaced in the near term, you really want to take into consideration the timing of withdrawals based on that calendar year. So any money taken out in December, for example, can be replaced as early as January the following year, so 1 month later. However, funds taken out in January cannot be replaced until January of the following year, so a full year later. So something that you want to be aware of. There are no limits on how much you can withdraw from your TFSA in any given year, and it's important to remember they do not count as income, so there's going to be no impact on benefits such as your old age security. Contribution room and withdrawals often provide some confusion, so let's take a look quickly at 2 examples to give you a sense of how that works. So in example 1, assume you've been regularly contributing to maximize your TFSA as of 2022, and you've contributed a total of $81,500. Assume the account has been performing well and it's now valued at $100,000, and you've decided to withdraw the full amount in December of 2022 to complete a renovation on your home. Now, come January of 2023, the following calendar year, your contribution room is going to be made of this year's contribution room of $6,500, unused contribution room from previous years, which we know was 0 because you were making use of all of it, and then plus the withdrawals made in the previous year of $100,000. So your total contribution room as January 2023 would be $106,500. Now let's look at a second example where there's been losses within the TFSA. If you would contribute $50,000 by the end of 2022, that would mean you have $31,500 in unused contribution room. Assume the value of your TFSA dropped to $10,000 from $50,000 contributed, and you've decided to withdraw the full amount in December 2022. Now come January 2023, your contribution will therefore be this year's contribution room of $6,500 plus unused contribution room of $31,500 plus withdrawals made in the previous year of $10,000 for a total of $48,000. Note the $40,000 in loss in the TFSA is not considered a withdrawal, and the only amount that would be part of the TFSA contribution room is the $10,000 that was withdrawn, not the full initial $50,000 contributed. So how does a TFSA differ from an RRSP, and which should you contribute to? This is a question that comes up frequently. So while TFSAs and RRSPs are similar in that they offer tax advantages for Canadians, there's really unique differences in how they work and therefore how they are best used. An RRSP is really designed specifically to provide you with income for retirement. Your contribution room is going to be based on previous year's income, subject to a maximum annual contribution limit. Contributions are tax deductible, however, withdrawals are going to be subject to taxation when you withdraw later in the life. TFSAs, on the other hand, can be used to save for a wide range of goals, including shorter-term goals. While the contribution amount is not related to your income and contributions are not going to be tax deductible, the TFSA does provide a great amount of flexibility to withdraw at any time with no taxes being paid. And as we talked about, you are able to recontribute amounts that are withdrawn from your TFSA the following calendar year or subsequent years without impacting your contribution room in those years to enable you to then start saving for your next financial goal. So based on the unique attributes of TFSAs and RRSPs, including the flexibility of withdrawals and income tax considerations, you'll want to consult with your advisor on which account is most effective based on your unique circumstances and the financial goals that you're working towards. Now lastly, we would like to speak about highlighting a few key mistakes that we see clients make really frequently with regards to their TFSA to ensure that you're able to avoid these errors and use your TFSA most effectively. So the first mistake we see is people using their TFSAs as a savings account rather than really an investment account. TFSAs are not designed just to be an alternative to perhaps a high interest savings account that you have. You really want to use your TFSA as an investment account with the objective of generating attractive returns on a tax-free basis over time, rather than just a savings account where you might have high interest savings or GICs to make the best use of your TFSA and the tax-free growth available to you. Secondly, the mistake that we see is over-contributing. The rules surrounding contributions and withdrawals, as we talked about, can be complex to track. If you pull funds out, make sure you're not recontributing into the following calendar year to avoid penalties. And if you have multiple TFSAs, you want to ensure you're carefully tracking contributions and withdrawals for each TFSA so that you do not incur these penalties. And thirdly, not taking advantage of contribution room. We often see clients that are paying income tax on investments, in non-registered accounts while not taking advantage of the room available to them in TFSAs to grow those investments tax-free. So ensure you're making use of this tax advantage vehicle that we are provided in Canada. As a final comment, TFSAs are a really great way for young adults to start educating themselves on investments and saving towards a financial goal. So this is a really great opportunity to start those discussions with your children on financial planning and investing and setting those goals for your financial future. So thank you for joining us today to discuss TFSAs and how to use them most effectively going forward. Please take a moment, if you can, like this video and subscribe to our channel. It really helps us to get this content into the hands that need it most. Thank you for joining us.